Hey, good morning once again, options traders. Well, to kick off the new year, I wanted to talk about some of the important trade offs with options. Those will be some of the topics I'll be covering here in the near term. And one that I find that is often overlooked among traders is what's the risk of rolling an option? And you hear me talk about, as well as many other traders, about the benefits of rolling. We roll our calls up, we roll our puts down, it sweeps cash into the account, we still keep our deltas. Yes, we get a lot of benefits. But one of the points that I want you to really remember is that there is always a trade off. You pick strategy A over B, there's a trade off. Do you know what those trade offs are? And if you don't know what the trade offs are, you need to be real hesitant about pulling the trigger on the trade. Well, this is a type of strategy. It's a move, it's a roll. What are the trade offs? Sure, there's benefits, but what's the risk of rolling an option? Well, let's go have a look. And as always, before we do, please be sure to click like and subscribe. It is really greatly appreciated and does help to promote the channel. So quick refresh. Remember what rolling is. Let's say that you buy the $100 call, maybe you pay $5 for it, and the stock price rises. Good thing, that's what we were hoping for. And at a later time, you could sell the $100 call for 8. But instead you choose to roll it. And what you would do is sell the $100 call for 8 and maybe buy the 105 call for 4. And of course, we would do this as a simultaneous order. That's really selling the 100-105 vertical spread. And in this instance, we would get a net credit of 4. And that's because once the trade is executed, we collected 8, and of that 8, we are spending 4. So we're pocketing $4, but now we effectively own the 105 call for just $1. Why? We initially spent $5 of our money. We put that at risk, hoping the stock would go up. And instead of just outright closing it for 8, we've sold it for 8 and then put $4 back into it. So this net credit of 4 is reducing our effective cost basis. Now, part of the trade-offs here is we no longer have the right to pay 100. We have the right to pay 105. We've given up 5 points of a benefit there. But the main thing is that most people say, oh, this is the only trade to make. No other consideration because I've reduced the risk from 5 to 4. And yet I still have all of the unlimited upside. Well, partly true, but what is the risk of this roll? All right, well, first let's start out with the benefits of the roll. The initial call was here in black, the $100 call for 5. That's our maximum loss. When we rolled to the 105 call in red, yes, we did shift this part higher. That was the real reason, the big benefit of the roll. We used to have $5 into the trade. Now we have $1, effectively. And of course, we can see that we've pushed our break-even point out a little bit. That's what I just talked about. We used to have the right to pay 100, but now we have to pay 105. So we're giving up $5 of intrinsic value or potential intrinsic value in exchange for $4 cash for sure in the hand. But what's the big risk? What's the one that everybody overlooks? Well, yes, we got the $4 credit, but we passed up the $8 for sure gain. This is it. In the previous example, I said that we assumed that we sold the $100 call for 8, and then we put $4 back up into the 105 call. That's where that $4 credit was coming from. So the question that you have to ask yourself before you roll is this. This is what we paid for this new call. The question is, can you beat the $4 or whatever price it is that you paid for the call? Because you're passing up $8 for sure, and you're putting 4 of that 8 back into a new call. And the reason you're trying to do that is you're expecting to get more than this. And that's really the opportunity cost that I want everybody to understand, is not to say that it was just simply a benefit because I got a $4 credit. We had to pass up this $8. So that means that it's going to give you a different perspective, that you have to consider time and volatility as to whether it's worth doing the roll or not. So to see some of the effects, let's jump over to an Excel spreadsheet. All right, so here's an Excel spreadsheet. It looks really complicated. It's actually quite simple. Let me just step through the columns. Here are different ranges for stock prices. Here is the theoretical price of the $100 call with 30 days to go. So if the stock is 94, it's worth 40 cents. If the stock is at 100, it's worth 229, and so on. This is the same call, the $100 call, with only 20 days. So we're just going to assume that you bought the call with 30 days on it. You're thinking about rolling it. and you're going to roll it to the 105 call, which of course would also have 20 days until expiration. Over here at the right, we have different days to expiration just for the 105 call. So remember, when you roll to the 105, it's got 20 days till expiration. We're going to see the value of that call with 18 days, 16 days, and so on all the way down to 2. So now that you understand what the sheet is, it's actually quite easy. Let's start off with just pick some numbers. Let's say the stock is 100 and you bought the 30-day $100 call for $229. And now 10 days have gone by, so we've got 20 days to expiration. The stock is up at 105. And that call is now worth $537. And this is where traders will say, oh, great, let's roll it. And here's what I want to show you to consider. You paid $229. You could close it for $537 and put that in your pocket right now. And if you did, that's 135% on your money. But if you roll it, what do you have to do? You have to buy the 105 call for $1.96. This is the big question. Can you beat $1.96? That's the driving force behind whether you should roll or not. Because right now, your net credit, which is $537 minus $1.96, is only netting you $341 as a credit. So in this case, you have a 49% return on your money, which is certainly not bad. At least you're above water. But if you start rolling too soon, or if you're using longer dated options, you still might be underwater here. And that makes it an even more important decision. So you're giving up 135% for sure in exchange for 49%. But the question that you have to ask yourself, and what I want you to start looking at, is this number right here. We had to pay $1.96 for that 105 call. And that now becomes your reference point. I've got to beat $1.96 in order for this roll to become effective. So I'm going to just call that the hurdle. Let's make this $1.96. And when we do, the Excel spreadsheet is going to highlight all of the option prices that are above $1.96. And this is something you can just do with a pricing model. I've shown you the OIC's pricing model before. Just go into a pricing model and do this same drill. So in other words, I'm trying to beat $1.96. Where can I do it? Well, if the stock goes up to 106 with 18 days to go, that's what this column is, I can get 241. I'll beat it by a little bit. And I'll beat it all the way down except here. I'm only going to get $1.95. So as long as the stock goes up a point with more than 10 days till expiration, it would have been better for me to have rolled. But if it takes longer than 10 days, it's going to be worse. Remember, when I bought this call where there were 20 days until expiration, this column shows 10 days until expiration. So that means that 10 days have passed. So that's going to start decaying quickly. Now I could also ask, where would the stock have to be before I can be assured of getting at least $1.96? Let's just call it $2. Well, that would be down here. This entire row, except I'm not showing right at expiration, always nets at least $2, but the stock has to be at 107. So now the question is, do I think the stock is going to be at 107 between now and expiration? And if the answer is yes, I will be better off rolling. I can do some other forms of analysis. I could say, well, if I'm going to pass up the $537 for sure by just closing the call, I don't want just $1.96. Maybe I want to get $3. What's going to happen now? Well, I would have to have that stock at 107 within 2 days in order for that to happen. Highly unlikely. Where would the stock have to be before I could get that for sure? At least all the way down until 2 days to expiration, stock would have to be at 108. And if I think the stock's got the ability to get to 108 between now and expiration, just with 20 days to go, and that's my hurdle, then yes, it would pay for me to roll. We can also look at the risk. What if I'm wrong and the stock falls to 103? Look at that, it's going to be $1 back instead of $1.96, and it's only going to get worse over time. So you better have a pretty good sense of confidence that you're not going to go in the opposite direction. So this can give you a real good sense of how much is at risk, how quickly that options price is going to fall off. So I hope that gives you some things to think about. The main thing to understand, the single point, is that when you roll, the price that you pay for the new option becomes your hurdle. And the decision to roll comes down to if you think you can beat that price. It's not to roll just because you get a credit. It's always a trade-off, and this is the amount that you are trading off. So I hope that gives you a different perspective to think about rolling for the new year. So remember, when it comes to rolling, don't roll just because you can. Don't roll just because you get a credit. Remember that all decisions are trade-offs. Consider the chances to beat the premium paid on the new option. That's really what the rolling decision comes down to. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. You can find it all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.